Actively managed, exchange-traded funds account for 33% of all ETF inflows this year through May. That's despite representing just 7% of all ETFs, according to a report. And our next guest thinks that they might be the best play for an uncertain back half of the year. And to discuss this further, let's bring in Cinthia Murphy, VettaFi investment strategist, as part of the ETF report brought to you by Invesco QQQ. Cinthia, great to speak with you. Great to catch up here once again. All right, so break this down for us. Why do you think that these are the most in-demand active ETFs for the second half of the year?
Hi, Brad. It's been a big year for active ETF demand because it's a time when people are trying to be more hands-on about positioning themselves in this amount of uncertainty going forward. If you look, the demand for your classic index-based portfolios, whether it's in equity or fixed income, that remains strong and really robust. But active is a little bit of a new phenomenon in the ETF space. It's been around forever, but it never really took hold until recently, when more product, better product, lower fee products really started to emerge. So we've seen not only a huge amount of launch of interesting strategies, things like in categories that didn't exist before, like buffered investing or a lot of options-based equity income, things that we couldn't do it before in a lot of the index-based strategies. All these things now exist and they're accessible from a price point perspective, and we're just seeing investors really embrace it as a way to either diversify portfolios or to look for alternative income strategies or better risk management tools, all of which apply in an environment where we don't know where this market is going.
We were speaking earlier with one of our guests, Brian Mulberry, who was telling us about this flight to quality. How are we seeing that play out in the ETF landscape?
Yeah, the flight to quality is interesting because it speaks to sentiment. So at VettaFi, we recently did a poll where we asked advisors, how are you feeling about the second half, bullish or bearish? And a higher percent of advisors said they feel more bearish going into the second half than they felt more bullish. And you're seeing that expressed in a demand for, quality. So for example, if you've really been in this growth train and you're just buying up your NVIDIAs and your Microsofts and your Apples and you really chase the Mag 7 and you're all in, all of a sudden you're worried about, can they keep delivering on these earnings? Can they keep delivering surprises to the upside? Or is it time to really focus a little bit more on quality? So funds like Q Grow, for example, really stand out as you stay invested in growth, but you're really looking for fundamental quality in some of the names. We've seen demand for things like, free cash flow companies that's a suggestion of a sign of financial well-being. So funds like VFLO, VFlow, or some of your cash cows also stand out in this space. So the flight to quality has been happening both in equities and in fixed income, again, as a safety guard, as a little bit of a defensive positioning ahead of what comes next.
We were also, and I'm just having all of these little kind of remembrances of conversations that have had some of the very themes that we're talking about, but within some of the kind of larger realms of what thinking investors may be going through right now. And one of them that came up was GARP, growth at a reasonable price here. How does that play in over an ETF strategy that someone wants to roll out as well?
Yeah, there are a couple of interesting funds in that space. One, the ticker is GARP. The other one, DARP, D-A-R-P. These are strategies that, again, they want to keep you invested in growth. If growth is your thing, if you just think classic growth versus value, and you really want to lean into growth, but you are worried about valuations. I mean, valuations are really stretched in the space, but leadership has been very narrow in this space as well. So when you go to something like a GARP, you tend to find names that aren't your Mag 7 so heavily weighted. You tend to find things that are they're fundamentally strong, they're growing businesses, but they haven't been big headliners, so there are more attractive valuations. So it's almost like introducing a valuation screen to your growth play, which again is a bit of a safety guard, and it's something that is starting to appeal to a lot of folks who they don't want to give up on the gravy train of growth because nothing has suggested anything breaking there yet. I mean, momentum has slowed down in growth, but they want to stay invested in that, but they're just taking a more precautionary tone with some of these valuation metrics introduced there.
Cinthia, always a pleasure to get some of your insights, and thanks so much for joining us here on the show today. Really appreciate it. Cinthia Murphy, who's the VettaFi investment strategist, joining us here on Wealth. Thanks so much.
Thank you so much.